If the US government can print their own currency, why do they need to issue debt? Why is refinancing $9 trillion of US debt important this year? Why don't they just do it at 0% interest rate and buy all of their own debt? My name is Forrest Hodl. I'm on X and Noster, and I'm a Bitcoin coach. I teach Bitcoin one-on-one for all your security needs. Any questions you might have, you can check that out in the link in the description. Now, this is a question I got from a regular viewer of the channel. I'm going to read this out to you and explain why I think this is relevant and try to answer it the best I can here. So can you go over on why the government has to refinance the debt and why they can't just make their own interest rate at zero because they control it? Why do they have to tank everything to make it so that they themselves charge the interest rate to refinance it cheaper? I just don't understand this refinancing its own debt cheaper idea. Who controls the rate for the government refinancing their own debt? So I think this is relevant because this is a place that you might already know this, you might already understand this, but I think as you go down the rabbit hole of understanding Bitcoin, it gets you into the way the money printer works, the way the debt market works, and you're eventually going to ask yourself this kind of question and try to figure out, okay, if they have the money printer, why do they need to issue debt? Why can't they just make their rate at 0%? Who is buying their debt? You start to ask yourself this kind of stuff. So to understand this, you kind of have to begin to understand the bond market. So the government issued debt, treasury securities, they are a type of debt instrument and they get issued and somebody buys them. So what happens, right, is when you have buyers and sellers, you have to, as a seller, you have to present something, you have to have some sort of value proposition in what you're selling for the buyer to want to buy it. So with US debt, what that is it's the concept, the contract, the note that gives you back your principal investment plus interest rate. So what that means is basically you spend $100 on a US bond and it has a 5% rate and it's a year-long bond. At the end of the year, you get $105 back. So you get an interest rate on the investment that you put in. Now, you don't expose yourself to future free cash flows like a company. It's a different type of instrument, right? What the bond market is really doing when it values this, it's going to compare interest rates, compare risks of defaulting compared to bonds. And the bond market is much bigger than the stock market. So that should be recognized and realized how important that is. And they look at basically U.S. Treasury bonds as unable to default. And I'll get into the reason for that. So they typically have the lowest risk. So there's that, which means that they might have lower interest rate. They're giving back a lower yield than some higher risk bonds, like maybe corporate bonds or other sovereign nation bonds. Or, so all the way down the corporate ladder into higher risk companies, which issue something which is referred to as junk bonds with really high interest rates comparative to the lower risk US Treasury. Now, what a bond buyer is looking at, right, is they're evaluating risks, they're comparing different debt instruments for yield, and they're also debating inflation risk. So say we have a 10-year bond. If the expected inflation for 10 years is higher than the interest rate given on the bond, then that bond has to lower in value, which means the yield based off of that purchase price goes up. Those two things are directly connected because you're paying less for the same yielding thing, but because you're paying less, the percentage yield you're getting is higher. The dollar nominal amount is still the same, but you're paying less for this instrument that pays you that same amount. So the interest rate percentage goes up when the value of the bond goes down. So if inflation is really high, the bond market is going to say, hey, we don't want these low yields. We don't want these low yielding bonds. We want higher yielding bonds, and we're not buying bonds until they go up in yield and down in price. So let's get into two of the metrics of what determines the yield on bonds. First off, it's it's that bond market, right? And who buys treasury bonds? So 30 to 35% of that is actually domestic US public and private investors. So that's mutual funds, pension funds, insurance companies, banks, individual investors. 25 to 30% is foreign government and investors. So Japan is a really big holder at $1.1 trillion of US debt. China has 800 billion. It's a declining trend. They've actually allowed a lot of their bonds to roll off. And there's many other nations out there as well. So the government itself holds around 20% as well. And they hold that in the Social Security Trust Fund, military retirement fund, civil service retirement fund, and other funds that they might have. Now, the rest is the Federal Reserve. So the US Federal Reserve holds around 20%, and the Fed buys treasuries as part of its monetary policy, and they hold that on their books. And this is what gives the US bonds basically a undefaultable label to them, is the Federal Reserve has the money printer. And they can always backstop. They can always buy the bonds that the bond market isn't willing to buy or isn't able to buy. So they step in with something, monetary policy or quantitative easing, and they buy bonds with newly printed money. Now, what's very interesting about all of this, right, is the Federal Reserve is supposed to be a private entity. They have the control of the currency for some reason. They have the ability to print money, and the government is supposed to deal with spending and treasury issuance, and they're supposed to all kind of work together but be separate entities. And the Federal Reserve has dual mandates of stable prices and low unemployment. And so that's kind of what they're aiming for. And the government has all of what they're aiming for. And in my opinion, they're a lot more connected than they might want people to believe. And they both typically have the same goal because the Federal Reserve ends up having to bail out the government in the end anyway. So let's get into the Federal Reserve now. So the Federal Reserve is the lender of last resort. And in this way, they also dictate what yields there are in the bond market. So if everybody's paying attention to Jerome Powell around the FOMC meetings, and they set something called the Fed funds rate, or the overnight lending rate. And what this means is basically other banks can borrow at a last resort. They can borrow at the overnight lending rate that the Federal Reserve has issued. So if they raise the rate, then it's going to cost more for the banks to borrow, and it's going to then trickle down to the way the bank lends, the way the bank operates, and the way the bond market sees bonds. Let's get into why the Federal Reserve is the buyer of last resort, not the first resort. I think this is what sort of answers that commenter's question a little bit. If the Fed stepped in and bought all of the debt from the US, they would do that with freshly minted money, and that would be a lot more money in the system, and that would mean that there's a lot more money chasing the same amount of goods, which would cause inflation, right? Which causes an unaffordability to life and causes a whole knock-on effect of problems. The other thing that might happen is if all of this money is printed at nothing, and you just spend, a few hours making one of these pieces of plastic, a $50 bill, and you spent a bunch of time doing that, and then all of a sudden there's millions, billions, trillions being printed out of thin air at no cost of production, you might say, that sounds kind of unfair. And of course, this is happening. It's just slow, so maybe it takes years and years for you to feel it, and you get angry at the wrong people for it. But this is happening, and if it happened really quickly, or if it happened too much, the confidence in the currency would erode, which would cause people to say, hey, this isn't really redeemable for anything. The only reason this is useful is because some other sucker is willing to take this for some other good that actually had a real cost of production. So what you would do is you would offload that currency. You would try to swap it for assets that might be denominated in some other government's currency if you want to trust them, or maybe something like Bitcoin that doesn't require trust in some sort of country. It has a supplied issuance, it has a fixed amount, or even something like gold, which has its supply issuance is dictated greatly by nature, right? So we have the idea of scarce assets becoming more valuable, and that's part of inflation as well. So that goes into inflation not just with consumer goods, but with assets as well. So that's why we've seen housing go up, not because houses are more useful or more valuable than they used to be, but because people do not want to save in this, because if you're a saver, you're a sucker while money is being debased, and you want to buy scarce assets like potentially real estate and store your value in that, because that will at least keep up with probably the the debasement that is happening. And that's why we see assets appreciate in price. So confidence might erode. And then the other thing that happens there is those bonds, that government debt is issued in the government currency. So people will offload that debt as well, because they don't trust that currency, they don't trust that debt, and that devalues the currency. That makes the yield on those bonds go higher if they ever need to refinance. It causes a whole skew of issues. So, and that leads into the bond market, right? So the bond market begins to panic. They start to realize that the yields they're getting aren't worth it. They start selling. They start demanding lower prices, higher yields. And then anybody that holds these really long duration bonds, and we can look back as close to Silicon Valley Bank. The reason Silicon Valley Bank collapsed was because they believed Jerome Powell when he said inflation was transitory and that we're not going to raise rates and we're going to keep it near zero. So you might as well stock up on bonds. And Silicon Valley Bank had terrible risk management, and they did exactly that. They bought the most secure safe haven asset, long-term treasury bonds. Now the problem is interest rates were so low, the yield was so low on those, and the Fed, instead of not raising rates, they raised rates quicker than they ever have before in such a condensed amount of time. And so that means those bonds, as long as the Silicon Valley was able to just hold those bonds until maturity, yes, they lost a bunch of purchasing power because they were forced to hold these bonds. But if they have to sell those bonds, the bond market is only willing to buy them at very low prices compared to what they bought them at, because they demand the yield, right? And those things are inverse. So when that happened, when Silicon Valley Bank had a bank run and they needed to provide more liquidity to their customers, when people were withdrawing on insolvency speculation that this bank was insolvent, they were withdrawing all their money. So Silicon Valley Bank was forced to sell some of their assets that they had put their customers' money into, which are these long duration bonds, and they sold them at distressed prices, and that caused them to be insolvent. So there can be all of these knock-on effects. So banks, they hold a lot of their capital in U.S. bonds, being the safe haven asset, and there's basis trades going on of people holding bonds and selling futures and vice versa, and all sorts of stuff. Leverage with leverage on top of that. So if rates go up, if the Fed steps in and buys a bunch of bonds, it's going to affect the interest rates like crazy. And basically, it's going to cause a huge domino effect of complete and utter destruction, because a lot of the financial system is built on the perceived stability of the U.S. government debt. Of course, with that instability would come crashing stock prices, crashing bond prices, higher yields, businesses going under that are too over-allocated, too leveraged, and this would cause huge amounts of asset inflation potentially in certain assets, safe haven assets, maybe like gold or Bitcoin or maybe real estate. And it would cause massive unemployment as well, which again goes against the dual mandate of the Fed and cause a huge amount of destruction. It would be very, very terrible. When you look at this, you might seem, okay, well, that all seems fairly obvious. There's a reason why the US government doesn't just print all the currency to pay their own debt, because it would cause, again, the confidence in the currency would erode, inflation would spike, and the bond market would panic. These are the three main issues that would be caused. Now, all of that is happening still. It's just happening in slow motion, or it's happening slower than if it was all to happen at once, of course. So you should still recognize that happening and realize that the only scarce asset, in my opinion, is Bitcoin. It has the total supply of 21 million, never any more, has fixed issuance, so we know exactly how much is getting released. If you were to try to get more of it, there's a difficulty adjustment that happens. So the same amount of Bitcoin is issued over time because of the difficulty adjustment. No other commodity is like that. So it is truly, truly unique, and therefore will be the best performing asset into the future, and has already been the best performing asset of all time. This question from some people might seem very simple to answer, but funny enough, about a year ago, this guy, Jared Bernstein, who was actually the chair of the Council of Economic Advisors for President Joseph Biden, was featured in this documentary called Finding the Money, and I'll link this clip below. He tries to explain why the government borrows when they also print their own currency, and he basically just resays that over and over. Well, the government does print their own currency, and yes, they do issue debt, and yeah, the debt is issued, and they could print their own currency, but they don't, and they don't buy their own debt, and yeah, there's nothing confusing about that. And I'll link that below. Unfortunately, I can't play it on this video. Otherwise, I'll get copyright stricken. But yeah, hilarious. And that was a year ago. And that was somebody that was closely connected to the US government, especially on the economy side. So not a crazy question to ask, not a crazy thing to not understand. It's complex. The bond market is often seen as something that's boring. To me, it's incredibly interesting because it is so ripe for disruption, and it is so fundamental to our entire economy that we exist in. So if you guys feel like I missed anything, of course, the comment section is for that. If you guys want to get yourself some Bitcoin, I would recommend Bitcoin Well. It's where I buy all of my Bitcoin. They're a non-custodial exchange, which means when you send them dollars, send them some dirty fiat, they send you Bitcoin directly, and they can do so to your hardware wallet like one of these. And therefore, you don't have any counterparty risk. And if you want some extra help, figuring out security, inheritance, whatever have you, I do one-on-one Bitcoin coaching. There's a link in the description for that. And if you want to preserve your seed phrase for future generations, I recommend checking out the Stampseed Titanium Seed Plate Kit and using my code BTC not crypto 15 for 15% off. Thanks everyone for watching, and we'll see you on the next episode of Bitcoin Not Crypto.